Welcome to today's Explainer. We are diving headfirst into what's shaping up to be literally the largest initial public offering in human history. We're looking at an event primed to completely reshape the financial landscape, and the hidden mechanics behind it all are absolutely fascinating. So the number you absolutely need to keep in mind today is $1.75 trillion. That is the reported target valuation for SpaceX. It's a figure so massive, so unprecedented, that it is the critical key to understanding why the rules of the financial system are seemingly shifting right beneath our feet to accommodate it. To put that into perspective, because honestly, a trillion is hard to wrap your head around, at $1.75 trillion, SpaceX would be worth more than every single American defense contractor combined. In fact, it completely eclipses the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks. All of those iconic brands put together. But here is the bombshell paradox at the center of all this. This record-breaking company, valued higher than some of the biggest brands on Earth combined, is actually losing nearly $5 billion a year. And the wildest part? Within a few weeks of its listing, your own retirement account might automatically become one of the biggest buyers of this stock, whether you actively choose it or not. Okay, let's dive into part one. 3 companies in one, beyond the rockets. To understand how a nearly $2 trillion valuation is even on the table, we've kind of got to look past the launch pads. SpaceX is really 3 completely different businesses stacked into one. You know, if you ask someone on the street what SpaceX does, they're almost always going to say rockets. But look at this revenue breakdown. The famous rocket business, launching satellites, sending cargo to the ISS, and running crewed missions, only generated about $4 billion last year. That's just about a quarter of the pie. A $4 billion revenue stream is impressive for sure, but it definitely doesn't justify a $1.75 trillion valuation on its own. Now, what's really interesting here is the actual workhorse of the company, Starlink. You can kind of think of it as Comcast in space. It is the fastest scaling telecom company in human history. With over 10 million active subscribers across 150 countries, Starlink brought in an estimated $11.4 billion in revenue for 2025. That's a massive 61% of SpaceX's total. But the real magic? The efficiency. Their profit margins absolutely exploded from 41% 2 years ago to 63% this year. They are essentially printing cash right now, locking down huge contracts in aviation, maritime, and even classified defense versions for the Pentagon. But then we have the third business, which was brought in through a recent all-stock acquisition, xAI. Now, the source analysis frames this as deeply overvalued, especially when you look at the broader artificial intelligence market. Check out the heavyweights on this table. You've got OpenAI generating $24 billion in annual revenue for an $850 billion valuation. Anthropic pulls in $30 billion for a $400 billion valuation. But xAI? They estimate just $1 billion in revenue. Yet it was bought and folded into SpaceX at a staggering $250 billion valuation. And the financials for xAI are where things get super complicated. It's actually been described as a reverse Jerome Powell, meaning instead of printing money, it takes the cash generated by Starlink and just lights it on fire. xAI is reportedly burning through over $1 billion a month. Plus, by March of this year, all 11 of the original elite co-founders had actually walked out, leading to public admissions that this $250 billion asset literally needs to be rebuilt from the foundations up. So when we consolidate all 3 of these businesses, the math is pretty brutal. You have Starlink printing cash and the rocket business doing well, bringing in roughly $8 billion in combined profits. But xAI's massive burn rate completely wipes that out. That results in a nearly $5 billion total loss last year, even though the whole company brought in $18.5 billion in top-line revenue. Let's move to part 2 and see how this builds. Rewriting the NASDAQ rules, the May 1st changes. So you're probably wondering, if a company is losing $5 billion a year, how on earth does it command a record-breaking IPO? Well, the answer lies in the underlying mechanics of the stock market itself. Specifically, a mechanism called passive index forced buying. The NASDAQ 100 is basically the gold standard for tech and growth companies, right? And there are over 200 investment products with over $600 billion in assets that simply track this index. If a company gets added to the NASDAQ 100, these passive funds are structurally forced to buy the newly added stock. It creates this automatic, guaranteed pipeline of billions of dollars in investment capital, absolutely no active stock picking required. Now, under the old rules, a newly listed company had to wait at least 3 months to be added to the NASDAQ 100. This waiting period was there for press discovery, allowing the market to figure out what the stock was actually worth before forcing passive funds to buy it. But a new fast entry rule adopted on May 1st completely changes the game. It cuts the waiting period from 3 months down to just 15 trading days. The analysis points out that this compresses months of market seasoning into a mere 3 weeks. So the crucial point is how this next rule pairs with that fast entry. Previously, to join the index, a company needed a minimum free float of 10%, meaning 10% of its shares had to be available for the general public to trade. Under the new rules, that minimum requirement has been completely eliminated. This is incredibly convenient for SpaceX, which is reportedly targeting a free float of only 4 to 5%. 6 months ago, this would have been an automatic disqualification. Today, they basically get a VIP pass. And then we have what's being called the hidden multiplier. Buried right there in the technical language of the new rules is a clever mathematical trick. For companies with a free float under 20%, NASDAQ now treats that float as if it were 3 times larger than it actually is. So SpaceX's tiny 4 to 5% float gets weighted in the index as if it were 12 to 15%. The analysis describes this as effectively manufactured demand, a way to legally require ETFs to buy significantly more of the stock than its actual public availability would normally dictate. Which brings us to the final layer of the onion, Part 3, your 401k as exit liquidity, the retail target. Okay, so if the runway has been cleared and the demand has been mathematically manufactured, who is actually on the other side of these trades buying up the shares? Historically, most initial public offerings allocate about 5 to 10% of their offering to retail investors, everyday people like you and me. But SpaceX is targeting a massive 30% retail allocation. And this brilliantly illustrates how vastly disproportionate this is compared to standard historical IPOs. That is a huge amount of supply being directed straight at the everyday investor. The company's stated reasoning for this approach was shared on the record by Brett Johnson, the CFO of SpaceX. He told a room of bankers that retail will be a critical part of the IPO because, quote, retail buyers have been incredibly supportive of us and of Elon for a long time, and we want to make sure that we recognize that. So the official stance here is that this 30% allocation is a reward for long-term loyalty. But that official statement contrasts pretty sharply with a critique from the financial sector. Portfolio manager George Noble looked at these mechanics, the accelerated timelines, the eliminated float minimums, the manufactured index demand, and stated bluntly, your 401k is the exit liquidity. The argument being made here is that the system is perfectly designed to allow insiders to unlock their shares at peak valuation, shifting them over to passive funds and retail retirement accounts whose mechanics literally force them to absorb the supply. It all leads us to this final provocative thought. Passive investing has long been sold to us as a total triumph of common sense, right? Low fees, easy diversification, just set it and forget it. But as we've seen in this explainer, the very mechanism that makes passive investing so wonderfully convenient is the exact same mechanism that automatically buys whatever gets added to the index. So is the convenience of passive investing forcing your retirement account to be a guaranteed buyer of a nearly $2 trillion currently unprofitable company that you might never choose to buy on your own? It's a fascinating question and for sure, one you should keep in mind the next time you check your portfolio.